Okay, the market's wild ride has left many investors wondering where they should put their money, of course. Well, my next guest says for the most part, his investors have been fairly quiet, and they're taking a steady as she goes approach to the market's big swings. Well, Jim Dunigan is the Chief Investment Officer at PNC Wealth Management, where he oversees more than $100 billion, and he joins us now live from Philadelphia. Jim, welcome to Fast Forward. Let me ask you first, your client's staying relatively quiet. I'm sure that's a completely relative definition of quiet. Are they just not as concerned, or having gone through the financial crisis not that long ago, are they just better prepared?
I think probably it is, Lisa, a little better prepared this time than last. We don't see, certainly in this market disruption, the stress levels in the credit markets. So it's been focused on the equity side, which made it a lot less anxiety levels are a lot lower than they were before. Nobody's happy about it, but they do see that hopefully we do get a return to economic activity and we get past this debt debate, deficit debate that we've seen, downgrades, and get back on track from an economic standpoint.
Well, Jim, let me ask you, what are you doing with clients' money? Are you pulling some of the funds out of equities, putting it elsewhere? Are you leaving it alone? How are you divvying up the money?
We're actually using this opportunity, Adam, for rebalancing. We left our recommended allocations at our baseline, so we have been fully invested for us in equity and fixed income allocations across those profiles. But where those accounts have gotten out of balance, adding to the equity side as those values have gone down, and nibbling with new money in equity markets for new investors looking to invest those funds.
Hey, well, what for you right now is, and I know every client's different, but in theory, what's your baseline? How do you divvy up the money? What percent to stocks, what percent to bonds, et cetera?
If we looked at a balanced profile for us, would be 65% in equities, 35% in fixed income, and 0 in cash in this environment. So as say, equity markets went down, we would take some money out of fixed income and add it to the equity markets here, rebalancing, looking for high quality in this market environment as it's volatile, and have had a allocation to higher yielding dividend stocks for some time, and would certainly use this opportunity to add to those positions.
Jim, let me ask you, I worked in private banking. You and I were just talking during the commercial break for quite a while. And one of the things you were trying to do with portfolio allocation is to find non-correlated asset classes. These days, it seems like everything is correlated. I mean, Adam and I have spent the last 4 mornings talking about what was happening in Europe, because that was directly impacting what was happening here in the U.S., and we were seeing all these markets move really in lockstep. Safe havens up, you know, riskier assets down. How do you manage the correlation across the asset classes?
Well, exactly. In these times of volatility, it's a little difficult to do that, but as it spreads out over time, you start to see those correlations go back to normals. But it is opportunities in there to add to sectors of the market that you do think are attractive, or that we think are attractive. So that's where you take those opportunities. But I think what's different from here than it was 08 and 09 is that everything was correlated. And here we see the equity markets correlated, but we're actually seeing, obviously, rebounds in the Treasury and fixed income markets, as there is some flight to safety around all of this. Sort of counterintuitive after you just come through a downgrade of U.S. Treasuries.
Yeah, it certainly is. And by the way, I noted that there was no allocation for gold or even commodities in your ideal portfolio.
We do have an asset allocation to the real return commodity sector of about 5% in those portfolios. So not specifically to gold, but we would have the commodity sector and real return as part of that. We don't think in this environment that inflation, at least on the near term, is a risk here, and we're probably back in this situation with an increase in the possibility of a recession, that we still have a deflationary risk out there as well. Those you have to balance out in a portfolio, which is a little bit of a task in this environment.
All right, Jim, we have to leave it there. Thank you so much for joining us here on Fast Forward. That was James Dunigan, Chief Investment Officer at PNC Wealth Management, coming to us, of course, live, Philadelphia.